Imagine entering the stock market, full of hope and excitement, only to realize that it's not designed for you to win. This is the reality for most people who try their luck with stocks. The market is a complex system, and many newcomers are unaware of its hidden pitfalls. Today, we'll uncover why 90% of people lose money in the stock market and what you can do to avoid becoming part of that statistic. Let's start by setting the stage for this journey into the world of finance, where suspense and uncertainty rule. Picture a dark screen, suspenseful music playing in the background, and a slow zoom that draws you in. The stock market is not a friendly playground. It's a battleground where only the prepared survive. This atmosphere sets the tone for the harsh truth that most people are not equipped to win. As we move forward, keep this sense of suspense in mind, because the journey ahead is filled with twists and turns. Suddenly, bold text fades in, revealing a shocking statistic. 90% of people lose money in the stock market. This isn't just a random number. It's a reflection of the reality faced by millions. The odds are stacked against the average investor, and understanding why is the first step toward changing your fate. Let's dive deeper into the reasons behind this staggering figure. Dramatic sound accompanies a statistics animation, emphasizing the gravity of the situation. Numbers flash across the screen, showing how the majority of investors fail to make profits. This visual representation drives home the point that success in the stock market is rare, and the risks are real. As we transition, let's meet someone who represents the typical investor. Let's introduce Ammon, a young professional living a normal lifestyle. He's ambitious, eager to grow his wealth, and decides to invest in the stock market. Like many, Ammon starts with optimism, believing he can beat the odds. His journey mirrors that of countless others who enter the market with high hopes, but what happens next is a lesson for all. Ammon makes his first profit and the excitement is palpable. The green chart rises, signaling success and boosting his confidence. This moment is crucial, as it often leads investors to believe they've mastered the market. However, the reality is that early wins can be misleading, setting the stage for future challenges. Let's see how Ammon's confidence grows. Zooming in on Ammon's face, we see excitement and a sense of accomplishment. His confidence surges, and he starts to believe that success is within reach. This emotional high is common among new investors, but it can cloud judgment and lead to risky decisions. As we move forward, let's explore what happens when the market takes a turn. Suddenly, the market crashes. The red graph falls fast and panic sets in. Ammon's excitement turns to fear as he watches his profits disappear. This dramatic shift is a reality for many investors, and it highlights the unpredictable nature of the stock market. Let's see how Ammon reacts to this crisis. Fast cuts and a heartbeat sound intensify the feeling of panic. Ammon is overwhelmed by fear, unsure of what to do next. This emotional response is typical when markets turn volatile, and it often leads to poor decisions. As we transition, let's see the consequences of acting on panic. Ammon decides to sell his stocks at a loss. The screen turns red, and a silence drop emphasizes the gravity of his decision. Selling in panic is a common mistake, and it often results in financial setbacks. This moment is a turning point, showing how emotions can override logic in the stock market. The first major reason why people lose money is a lack of knowledge. Books, charts, and confusion visuals illustrate how many investors enter the market without proper understanding. Without education, it's easy to make mistakes and fall into traps. Knowledge is power, and those who lack it are at a disadvantage. The second reason is emotions. Fear and greed drive many decisions in the stock market. Face expressions of fear and greed show how powerful emotions can be. Investors often react impulsively, leading to losses. Managing emotions is crucial for success. Short-term thinking is another major reason for losses. The fast-ticking clock symbolizes the rush to make quick profits. Many investors focus on immediate gains, ignoring long-term strategies. This mindset leads to risky moves and frequent losses. Institutional trading visuals show how big players control the data. These institutions have access to advanced tools and information, giving them an edge over retail investors. The market is often influenced by their actions, making it difficult for individuals to compete. Retail investors often react emotionally, especially during market volatility. Mobile trading panic visuals highlight how quick decisions can lead to losses. Unlike big players, retail investors lack resources and often follow trends blindly. The market rewards those who are disciplined. A slow rising graph shows steady growth, emphasizing the importance of patience and strategy. Investors who stick to their plans and avoid emotional reactions are more likely to succeed. On the other hand, the market punishes ignorance. Sharp falling visuals illustrate how lack of knowledge and poor decisions lead to losses. It's a harsh environment where only the informed thrive. A calm tone and slow zoom invite viewers to reflect. Are you investing or gambling? This question is central to understanding the stock market. Investing requires knowledge, discipline, and patience, while gambling relies on luck and emotion. The stock market is a complex system with many moving parts. Understanding how it works is essential for success. From institutional players to retail investors, everyone plays a role in shaping the market's direction. Emotional traps are everywhere in the stock market. Fear, greed, and excitement can cloud judgment and lead to costly mistakes. Recognizing these traps is the first step toward avoiding them. There's a significant knowledge gap among investors. Many rely on hearsay or follow trends without understanding the fundamentals. Bridging this gap is crucial for making informed decisions. A short-term mindset leads to frequent buying and selling, often resulting in losses. Investors who focus on quick gains miss out on the benefits of long-term strategies. Institutions have a clear advantage in the stock market. They use sophisticated tools and data to make informed decisions, often outmaneuvering retail investors. Retail investors face many disadvantages, including limited resources and emotional decision-making. Understanding these challenges is key to improving performance. Discipline is the foundation of successful investing. Those who stick to their strategies and avoid impulsive decisions are more likely to achieve steady growth. Ignorance can be costly in the stock market. Investors who lack knowledge are more likely to make mistakes and suffer losses. Continuous learning is essential. The stock market is an emotional roller coaster. Highs and lows can affect decision-making and lead to unpredictable outcomes. Managing emotions is a skill every investor must develop. Losses are inevitable, but they can be valuable learning experiences. Analyzing mistakes and understanding what went wrong helps investors grow and improve. Patience is a virtue in the stock market. Those who wait for the right opportunities and avoid rushing into trades are more likely to succeed in the long run. Herd mentality leads many investors to follow the crowd, often resulting in losses. Independent thinking and research are essential for making sound decisions. Managing risk is crucial for protecting your investments. Setting limits and diversifying portfolios helps reduce the impact of market volatility. The stock market is always evolving. Continuous learning and staying updated with market trends are essential for staying ahead. Emotional decisions often lead to regret. Taking a step back and analyzing situations objectively helps make better choices. Long-term strategies are more effective than chasing quick profits. Building a solid investment plan and sticking to it increases the chances of success. Understanding market trends helps investors make informed decisions. Analyzing data and staying aware of changes is key to navigating the stock market. Overconfidence can be dangerous. Believing you've mastered the market after a few wins often leads to risky behavior and losses. Learning from experts and experienced investors can provide valuable insights. Their strategies and advice help avoid common pitfalls. Building confidence through knowledge and experience is important. It helps investors make informed decisions and stay calm during market fluctuations. Panic selling is a common mistake. Staying calm and sticking to your strategy prevents unnecessary losses. Smart investing involves research, discipline, and patience. Making informed decisions and avoiding impulsive actions leads to better outcomes. Avoiding gambling behavior is essential. Investing is not about luck, it's about strategy and knowledge. Take a moment to reflect on your approach to the stock market. Are you investing with discipline and knowledge, or are you gambling with your future? This reflection is crucial for making better decisions. Let's summarize the key lessons. Knowledge, discipline, and patience are essential for success in the stock market. Avoid emotional decisions and focus on long-term strategies. Are you ready to approach the stock market with a new mindset? With the right knowledge and discipline, you can avoid common pitfalls and improve your chances of success. As the video fades out, remember to stay disciplined and keep learning. The stock market is challenging, but with the right approach, you can navigate it successfully. Take control of your financial future today.